which brings me to the next point here about the interest crediting strategy of an index universal life policy. And what we're talking about here is the next phase here, the difference between dividends and indexing. And then I want to mention a really powerful IUL alternative. So if the concept of upside potential, downside protection in the market interests you, I'm going to blow your mind here in a second. But let's talk about how these policies typically grow. All right, so dividends, it's pretty simple. I might actually, well, I wouldn't call it simple like how dividends actually work, but just to keep it simple, I'm going to do a separate video on exactly how dividends work in a whole life insurance policy. So make sure you guys subscribe for that update. But dividends, so with the whole life insurance policy, we have a guaranteed growth rate. And then because we are buying these policies from a mutually owned life insurance company, when we buy the policy, that makes us a part owner in the company, similar to like if you were to own stock in a company, right? But this is owning a policy with a mutually owned life insurance company. So what that means is that we actually participate in the profitability and the surplus, whatever surplus there is and whatever profitability the company has, that's redistributed back to us as policyholders. This is really powerful. So you're essentially a partner with some of the most powerful, best risk management companies in the world, some of the most financially strong and stable companies in the world that have been around for over 150 years, have never missed a dividend payment. You become a partner with that company with all the benefits within this policy. I think that's really, really powerful. All right. So those dividends, while they're not guaranteed, these companies have always paid them. The companies that I have my policies with just paid one of them paid their 120th consecutive dividend. And then the other one just paid 147th consecutive dividend. So very, very consistent, right? So that's how the cash value, as well as the death benefit, because your death benefit grows as well within a whole life policy. But that's how you get the growth of the policy. You have the guaranteed growth rate and then the dividends on top of that, okay? With an indexed universal life policy, that is not the case. You are not a partner with the company. So I hear agents talk about how, buying an IUL with these really these really financially strong companies, and they've been around forever. And while that's important when you're buying a policy to, like when it comes to the solvency of the company to make sure that they're going to pay out a death benefit and stuff like that, that's important. But usually, like when you're talking about the strength of the company, it's because you're a partner with the company. It's not the case with IUL. So it doesn't matter how profitable the company is with an IUL because you don't partake in that profitability whatsoever. In fact, you're contributing to the profitability of the company with an IUL. All the risk is on you. The risk is of the risk for the growth of the policy is put back onto you as the policyholder because you are relying on stock market index and options crediting strategy. That's really how the interest crediting strategy works, called indexing. You're relying on that for the performance and the growth of the policy. Okay. Not saying it's a bad thing, but that's why it's like, if you have a higher risk profile and you want to potentially get more growth than a whole life policy, which I don't really think is going to happen. I think it can happen. I don't think it happens very often, and I'm not willing to roll the dice on my financial future like that. I want something stable that's going to grow every single year, and then I can build wealth outside of it. Like, I'm not trying to build a ton of wealth with the policy itself. I want to put my money in a safe place that's going to grow, give me tax advantages. I have the death benefit, and then I can borrow against it to really build wealth, really accelerate the wealth building process, right? But with an IUL, it's not the case, right? You're injecting more risk into the wealth building process, which if you're okay with that, for that extra potential reward, by all means, go for it. Okay. But we're going to talk about the illustration later because these things look really good on paper. But anyways, with the indexing interest crediting strategy within an IUL, it's based on a call options strategy. All right. So what's happening is, and this is why they can have the 0% floors, because you're not investing directly in the market. You are buying call options on whatever index you choose. If you are going to do an IUL, I usually recommend doing the S&P 500. Don't do these proprietary volatility controlled indexes. Very, very shady stuff. I've got other videos on that. But anyways, what's happening is the company will invest in call options on the S&P 500. And if the market goes up, your cash value within your policy, you'll get a certain amount of interest credit based on that move, but based on your cap. So every IUL, I mean, they have uncapped strategies as well, but like I said, there's always give and take with these things, guys. But typically you're going to have a cap, 10%, 12%, whatever. They usually start you off at a really good cap rate and then lower it a couple years later to manage their risk. Yet they're still selling new IUL policies at the original 12% cap rate or whatever. It's kind of shady. But if the market goes, you get up to your cap rate. Okay. If the market goes down, then the options just expire worthless and you have your 0% or 1% floor, whatever. Okay. Now, here's the thing is within that call options strategy, there is a call options budget and the cost of call options that fluctuate constantly that will have a long-term impact on the performance of the policy. As options get more expensive because of volatility, supply and demand, right? There's more demands because IULs are really popular right now, whatever, right? The cost of those options are going to go up, which is going to limit how much you're able to earn within the policy because the life insurance company has to compensate for those additional costs. And they do that by pulling the different levers within the IUL policy to manage their risk, guys. It's really important to understand if I've lost you at this point, maybe that's a good thing because these are these are far more complicated than what they're made out to be. It's not as simple as upside potential, downside protection in the market. You have to understand where that promise comes from and if it's actually worth it. Like, is this actually going to work in reality? I'm not rolling the dice, but that's essentially how the IUL grows, right? With indexing, right? So they're buying call options on an S&P 500. If it goes up, you get up to your cap rate. If it goes down, you get your 0% floor, okay, or 1%, whatever. Now, the IUL Alternative. I've done videos on this. I will link it down below where I go into all the details about how this works, guys. But I'm just going to ask you a question here really quick. If you could get upside potential, downside protection like the IUL promises, but you could get that in a whole life policy without all the levers being pulled. There are some levers, but it doesn't put your policy at risk. It's still guaranteed to grow. You still have a lot of the guarantees of whole life. So just not having the same issues with IUL. If you could get that, is that something that you'd be interested in? Well, that exists. It's not very common. There's not a ton of options for it, but there are a couple of companies that actually will use your dividend that you would have received, and you can allocate a portion of it or all of that dividend to this indexing strategy. And if the market goes up, you can double your dividend potentially. If the market goes down, you would lose your dividend, right? So you're still injecting risk into the policy, into the wealth building process. So I'm still not a fan of it, but there is a lot less risk with it because you're still guaranteed to grow within the policy. You're not going to go backwards because of it. You're just utilizing the dividend that you would have normally received to do the call option strategy. So much safer way to do it, in my opinion. If you want to learn more about that, I'll have my training down below. Okay.
What's up, my fellow wealth creator? Thank you so much for checking out this clip from the Millennial Wealth Creator podcast. If you'd like to watch the full podcast, there will be a link down below in the description. Make sure to also check out the additional tools, training, resources that I have in the description as well, just to help you along your journey. Thanks again for checking out the clip, and we'll see you in the next one.